Hi there, it's Professor Liam. Today we're going to be talking about the accounting cycle at the end of the period. So we're looking at the accounting cycle end of the period. Cash doesn't matter in this situation. It's not that we don't have it on the balance sheet, we do, but we do accounting by what's called the accrual basis. Examples of dealing with expenses when they're incurred rather than when they're paid are rent. So in this case, we'll debit rent expense each month and credit prepaid rent regardless of when we pay. Similarly, we'll do this with supplies. Doesn't matter when we bought them. As we use them up each month or each period, we'll debit supplies expense and credit supplies based on account. Equipment is a more involved transaction than the others. First, when we buy the equipment, we'll debit equipment and we'll credit cash. One asset going up, one asset going down. However, we never mess with it again. Instead, as we show the item being used up and show it being pushed into expense, we debit depreciation expense and credit accumulated depreciation. This means at any given time, if you want to look at the net book value of equipment, it's equipment minus accumulated depreciation. We don't record any more into the equipment account until we sell the item. We have to keep up with accrued expenses even if they haven't been paid yet. For example, salaries expense is incurred the day a person works, and so we have to record that even if we haven't paid them yet. Similarly, sometimes we might have a note receivable, and even if we haven't been paid yet, if interest is due, we'll debit interest receivable and credit interest earned. These are called adjusting entries, and we're finished with them. What they do is they create something called an adjusted trial balance. This is our final trial balance, but it's really just a list of the accounts with their balances. We'll use this adjusted trial balance to prepare all the financial statements we talked about: income statement, balance sheet, and statement of stockholders' equity or retained earnings or something like that. Cash flow statement's a little different. Then we embark on a closing process, which is really just a matter of using journal entries to zero out revenue and expense accounts and get them ready for next year. When we complete this, we have something called a post-closing trial balance, which zeroes out the revenue and expense and only shows assets, liabilities, and equity. Well, take care and hope you do well in Chapter 3.